Why do existing shareholders face dilution concerns during an IPO? Imagine owning a piece of a company, feeling confident about your stake, and then suddenly more pieces are added to the puzzle. That's what happens during an initial public offering. When a company decides to go public, it often issues new shares to raise money. This means the total number of shares in the company increases. But what does that mean for the shareholders who already own parts of the company? Well, their ownership percentage drops because their shares now representing a smaller part of the whole. It's like having a pizza and then getting more slices added without increasing the size of the pizza. Your slice becomes smaller in comparison. This increase in shares also means your voting power decreases. If you owned a certain percentage of votes before, that percentage shrinks because more shares are floating around. So, your influence over company decisions lessens. Plus, earnings per share, which is the company's net earnings divided by the total shares, usually goes down. That's because the same earnings are now divided among more shares, making each share seem less profitable. If earnings per share drop, investors might think the stock is less attractive, which can push the share price down. Another concern is how dilution can affect the stock's value. When more shares are available, the company's overall value is spread thinner. If the market sees the new shares as a sign of good growth, the stock might hold steady or even rise. But if investors see the new shares as a way to get quick cash without improving the company, they might sell off, causing the price to fall. For shareholders who have invested expecting certain returns, dilution can mean their investment grows less than they hoped unless the money raised is used wisely. If the company uses the funds to expand and generate more profits, the overall value can increase, offsetting the dilution. From a trading perspective, dilution impacts how investors value the stock and options. When more shares are issued, the supply increases, which can influence the stock's price and how options are priced. Options traders need to watch for changes in stock volatility and price movements after an IPO because these factors directly affect options strategies. In the end, dilution during an IPO is a balancing act. It can reduce the ownership and influence of existing shareholders, but if the company uses the new capital well, it can lead to growth that benefits everyone in the long run.